Welcome to the Global Commerce Academy, your trusted platform for 100% free CMA USA classes. Today, we'll explore Chapter 4 Budgeting Methodologies from Section B, Planning, Budgeting, and Forecasting of the CMA USA 2025 syllabus. This chapter explains how budgets are structured and implemented, including the pros and cons of different methods, so let's begin. Budgeting methodologies are approaches to creating, maintaining, and reviewing budgets. Every business is different, so selecting the right method ensures better planning, improved efficiency, and effective resource use. As a CMA, your role is to choose the right budgeting method that aligns with your company's size, industry, and strategy. A static budget is created at the start of the period and doesn't change, even if business conditions shift. The benefits are that it's easy to prepare and sets clear expectations. But the drawbacks include being inflexible, and it may lead to unrealistic comparisons if conditions change. You'll want to use static budgets in predictable environments like government agencies or schools. A flexible budget adjusts based on actual activity levels, like units produced or sales made. The benefits are more accurate comparisons and the ability to adjust with reality. On the flip side, it's slightly more complex and needs real-time data. CMAs prefer flexible budgeting in dynamic environments like manufacturing or service firms. In zero-based budgeting, every expense must be justified from zero. Nothing is carried over automatically. The benefits? Well, it eliminates waste and improves cost discipline. But on the flip side, it's definitely time-consuming and needs detailed analysis. This approach is usually used in cost-conscious organizations or during restructuring. Let's talk about incremental budgeting, which is one of the most commonly used budgeting methods in both businesses and organizations around the world. At its core, incremental budgeting is all about building on what you already have. Instead of starting from scratch each year, you take last year's budget as your foundation, and then simply add a fixed percentage or a set amount to each line item. For example, if your department spent $100,000 last year, and the company decides to increase all budgets by 5%, your new budget would be $105,000. This approach is straightforward and easy to understand, making it a popular choice for many. The beauty of incremental budgeting lies in its simplicity and speed. Because you're not reinventing the wheel every year, the process is much quicker than other budgeting methods. There's no need for lengthy debates or complex calculations, just a simple adjustment to last year's numbers. This makes it especially attractive for organizations that are stable, with operations and expenses that don't change much from year to year. If your business environment is predictable and you're not expecting any major shifts, incremental budgeting can save you a lot of time and effort. It also helps maintain consistency, which can be reassuring for both managers and employees. However, while incremental budgeting is easy to use, it does have its downsides. One of the biggest drawbacks is that it can hide inefficiencies. Because you're just adding to last year's budget, any wasteful spending or outdated expenses can get carried over year after year without being questioned. This can lead to bloated budgets and missed opportunities for cost savings. Plus, incremental budgeting doesn't really account for changes in your business environment. If your company is growing rapidly, facing new challenges, or needs to adapt to market shifts, this method might not be flexible enough to keep up. It can also discourage innovation, since departments may be tempted to spend their entire budget just to ensure they get the same or more next year. In summary, incremental budgeting is mainly used by firms with stable operations and predictable spending patterns. It's a great fit for organizations that value consistency and efficiency, and where expenses don't fluctuate much from year to year. But it's important to be aware of its limitations, and to regularly review your budget for any hidden inefficiencies or outdated costs. By understanding both the strengths and weaknesses of incremental budgeting, you can decide if it's the right approach for your organization's needs. Let's talk about rolling budgets, also known as continuous budgeting. Unlike traditional budgets, which are set once a year and then left unchanged until the next cycle, a rolling budget is updated on a regular basis, most commonly every month or every quarter. This means that as each month or quarter ends, a new period is added to the budget, so you're always planning ahead for the next 12 months, or whatever your chosen time frame is. This approach keeps your financial planning fresh and relevant, allowing you to adapt quickly to changes in your business environment. By continuously adding a new period as time goes on, you ensure that your budget never becomes outdated. The big advantage here is that your budget is always current, reflecting the latest information and trends. This method really encourages long-term thinking and strategic planning because you're not just reacting to what's already happened, you're proactively preparing for what's coming next. It also helps organizations stay aligned with their goals, as they can make adjustments in real time based on actual performance and changing market conditions. However, it's important to be aware that rolling budgets do require regular input and can be somewhat time-intensive. Updating your budget every month or quarter means more frequent data collection, analysis, and decision-making. This can put extra pressure on your finance team, especially if resources are limited. But for many organizations, the benefits of staying agile and responsive far outweigh the extra effort involved. Certified Management Accountants, or CMAs, often use this approach in fast-moving industries where staying responsive is crucial. For example, in sectors like technology, retail, or manufacturing, where market conditions can shift rapidly, having a rolling budget allows companies to pivot quickly, seize new opportunities, and manage risks more effectively. Ultimately, rolling budgets are a powerful tool for organizations that value flexibility, continuous improvement, and proactive financial management. The best budgeting method really depends on several factors, like your company's goals, how volatile the business environment is, the level of control you need, and of course, the time and resources you have available. Often, organizations actually use hybrid models, so they combine different methodologies to get the best results. As we reach the end of this chapter, let's take a moment to reflect on what we've covered. Budgeting isn't just about crunching numbers or filling out spreadsheets. It's about making informed decisions that drive organizations forward. Each budgeting methodology we discussed, whether it's incremental, zero-based, flexible, or activity-based, brings its own unique strengths and perspectives to the table. Some methods offer simplicity and ease of use, while others provide a deeper level of analysis and control. Understanding these differences is crucial for anyone aiming to excel in financial planning and analysis. But honestly, what truly sets these tools apart is the strategic mindset that a CMA brings to the process. It's not just about knowing the mechanics of each method, it's about applying them thoughtfully, aligning them with organizational goals, and adapting them to real-world challenges. As a CMA, your ability to think critically and strategically transforms these budgeting tools from simple frameworks into powerful instruments for business success. Whether you're working in a multinational corporation or a small startup, your expertise in selecting and implementing the right budgeting approach can make a significant impact. I want to thank you for joining me in this comprehensive exploration of budgeting methodologies as part of CMA USA Part 1, Planning, Budgeting, and Forecasting for 2025. Your commitment to learning and professional growth is what will set you apart in the world of management accounting. Remember, mastering these concepts is not just about passing exams. It's about building a foundation for a successful and impactful career. And hey, if you found this chapter helpful, don't forget to subscribe to the Global Commerce Academy. By subscribing, you'll gain access to more in-depth chapters, expert insights, and practical tips, all designed to help you navigate the complexities of finance and management accounting with confidence. Here, we break down complex topics into simple, easy-to-understand lessons, always with a focus on real-world relevance. Our goal is to empower you with the knowledge and skills you need to succeed, whether you're preparing for the CMA exam or advancing your career in finance. Thanks again for watching, and I look forward to seeing you in the next chapter.